What does that mean for the consumer? Joining us now is Michelle Meyer. She leads the Mastercard Economics Institute, is its chief economist as well. Good to see you, Michelle.
Yeah, good to see you.
What are your metrics telling you about spending pace recently? Does it link up with what we saw in the official data?
It very much does. I mean, we've been seeing that on a high-frequency basis, a consumer that is very much continuing to spend. Now, of course, part of that is accommodating higher prices. So we've seen a pretty sizable increase in spending at the pump in the order of 20, if not almost 30% on a year-over-year basis. Now that, hopefully, we're going to see some reduction in gas prices, that will be a bit of an ease. But despite that increase in spending on the pump, and we saw in today's retail sales report, they're still spending elsewhere as well. So really doing pretty incredibly well in navigating this environment.
Does it matter if they are drawing down their savings in order to keep up the spending, in your view? I mean, in terms of gauging the health of the consumer, is that something that you sort of factor in?
Yeah, I mean, I think looking at all the different drivers of spending makes sense. I think the biggest one is income creation, and that's the labor market. And the fact that the last few months have been strong when it comes to job creation, pretty consistent wage growth, I think that is the primary driver for consumers right now, coupled with the wealth effect that has been positive. Now, when you realize your wealth effect, it means you tend to draw down your savings. So I do think that goes hand in hand, where more wealth accumulation, more confidence of the persistence of that wealth, you realize that by pulling down a little bit of your personal savings.
Yeah, I mean, the rule of thumb, if employment is relatively healthy, spending is going to follow.
Yeah.
I guess the nuances are, whether real incomes are rising or not, depending on how they're measured,
yeah,
and I guess the distribution of where the spending is happening.
Absolutely. So real wage growth is important. And you did see in the last report dip into negative territory because of this big pop in headline inflation and energy prices. But if that's temporary and we're going to see some easing of that, the rest of underlying inflation is pretty moderate. So core inflation, or all these different trimmed mean measures, are still running at a pretty reasonable pace, which would allow real wage growth to move back into positive territory.
We haven't mentioned Kevin Warsh yet today. I mean, we haven't mentioned the fact that he seemed hawkish, at least, in the press conference, and that he seemed committed, and he said the committee is committed to deliver price stability. Does that factor into your view that inflation is going to come down, the fact that the Fed is sort of going to press on that in a more concerted way, perhaps?
I mean, I think from my interpretation of listening to the new Fed chair is that he's very much in the view that the Fed has this mandate, of course, of price stability, and that matters. And in the long term, you have to have stable and reasonable inflation. I don't think it means that right now he's going to be worried and need to hike interest rates. And in fact, he was not commit. He didn't commit. Right. He was very clearly leaving things very open and noting that the committee is very divided as well. So we have to see how the data comes out. We have to understand how the reaction function shifts in the face of that. And they'll react accordingly to make sure that there's appropriate monetary policy.
It's a fascinating makeup of economic growth right now when you have just such this massive capex boom that seems kind of impervious to, interest rate modulation or anything else. And then consumers are kind of steady state spending, I guess, in aggregate. Are there risks in there in terms of becoming imbalanced one way or the other, or is this okay indefinitely?
Well, I think if you were seeing a sign of capex being the singular lead in the economy and everywhere else there was a contraction, then yes, I think you would worry about an overinvestment or, an excess of inventories being built up, which would tend to happen when there's too much investment, not enough demand. But you also have the demand, right? So I think the fact that consumers are still spending, the fact that the labor market is still churning, income is still being created, I think you do have both of these forces. You have the AI race in terms of capex and investment. At the same time, you have consumers that are seeing labor market fundamentals that are supportive and spending accordingly in an environment where the balance sheets are supported.